Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. Up this week, Activision. Now, Activision stock has taken a monster hit recently as the company's been embroiled in some turmoil with employees, some sexual harassment, some workplace issues that are somewhat outside the box, the financial statements of the operating entity. The CEO has said that he's going to take a pay cut, that he's going to work on those issues, and I have no doubt they will eventually solve it over time. The question is, does this discount now warrant buying the stock? Ready? Let's get to work. Before we jump into Activision, I do want to cover the 5 key attributes that we use to value all stocks at this channel. Number 1, top line revenue growth. You have to have it. Number 2, earnings growth. We want to see EBITDA strong and growing. Number 3, we want a strong free cash flow. Number 4 is low debt, less than 3 times debt to EBITDA. And number 5, we want a well-priced stock. What does that mean? That means you want to buy a stock at a price that's hopefully cheap, but doesn't have to be too cheap, but at a reasonable price so that over the long term, your performance, your return, your IRR on that investment beats the market. That's ultimately what I'm trying to do. This is my vlog, so that's my criteria that we use. I also want to recommend that you check out the one-pagers that I'm producing on my website, cashflowinvestingpro.com. I had already released Activision as the one-pager. You get a full 10-year look at the financials. You get cash flow. You get the entire cash flow forecast that I produce, as well as the recommendation and a possible IRR for the investment. Definitely check that out. But we're going to go through Activision here and see what we get. Ready? Let's dive in. Okay, the very first thing I want to do is we're going to pull up the annual report. Now, I encourage you all to read the annual report that every company files for each company that you own. You read it every year. You sit down, get a whiskey, get a coffee, get a water, whatever your deal is. Sit down and read the document. Most of it, you're not going to have to read every single year. A lot of it's boilerplate. But there's a lot of great stuff in there. The MD&A, the Management Discussion and Analysis section that follows the financial statements, is something you definitely want to read. That is management explaining in black and white what is happening in the business. It's not the glitz and the glamour of the quarterly reports or the press meeting. It is the hard facts that the SEC requires them to release. So I encourage you, everybody, to read the annual reports for every stock you have in your portfolio. That is going to limit the number of stocks that you can have in your portfolio, and it's going to focus your money on the top performing ideas that you have. Highly, highly recommend doing that. Let's take a look at their financials. So this is the annual report. This is revenue, fiscal year 2020, 19, and 18. And you can see total revenue, $8 billion, $6.5, $7.5 billion. So it is growing, a little dip and then back up. What I do want to point out here is what I love, in-game subscription revenue, right? Subscription revenue is very sticky revenue. And that is worth a little bit higher market multiple for a company that has subscription revenue. And this is actually more than 50% of total revenue for them is subscription revenue. That's a huge, huge checkbox for me. It's something I like to see. Scrolling down the financial statement, just really quickly, not to cover everything here, but you've got your cost of goods sold, software, operating expenses, product development, sales and marketing, so forth. Total cost, $5.3 billion for a net. This is their net income, operating income, $2.7 billion, up from 1.6 the previous year, up from 1.9, call it 2 billion, 2 years back. And that is a very, very strong number. You can take this number, you can add the depreciation to that number, you'll get your EBITDA. You don't really need what's below is taxes, interest, and the losses on extinguishment of debt, right? That's a one-time item. You don't count that in your EBITDA going forward. It's not routine. Okay, the next statement we're going to look through is the cash flow statement. Behind me is their cash flow statement. Always want to read the cash flow to see if the P&L is representing itself in actual cash money that they operate. And yeah, it is. Net income, $2.2 billion in a single year, up from 1.5 the previous year. Nice number. Their depreciation is really, really low, $197 million. Cash flow from operations, that's the first third of the cash flow statement that we want to look at. $2.25 billion of hard jack that they got from selling their subscription services, for after paying employees, after paying rent, utilities. They have this much sitting in the cash in the bank. That's amazing from operating in 1 year. That's up from $1.8 billion the previous year. What do they do with that money? Well, they can put some of that money back into the company. That's this line, the CapEx, capital expenditure line, $78 million. That is chump change. That is a rounding error for this company that generates $2.2 billion every year selling their wares. That's fantastic. That means that most all of this cash flows right through to the bottom section of the cash flow, which is the financing section. It's also the section where they buy back shares and they pay dividends. And I think that's where this money is going to go. In the recent year, they did borrow a little bit here this last year, but prior to that, they have not borrowed money. They've been buying back a lot of the stock. Let's take a look at our sheet that we use, like this one. We'll run through it quickly and we'll forecast this business. All right, now before we do this, I just want to remind you, check out my website, cashflowinvestingpro.com, the Cash Flow Investors Club, where you get one-pagers, many one-pagers a month, far more stocks than I can cover in this YouTube channel. Here we go. Revenue, we're starting with revenue, $4.8 billion to $8 billion, almost a doubling of revenue over this 9-year period of time. Fantastic job. It has not been a smooth ride, and I want to caution people, this is why we invest for over a decade, because year to year, quarter to quarter, judging a business based on those results is foolish, in my opinion. You want to pick a horse, hold it for a very, very long time, never sell it, never pay a dime in taxes for turning the portfolio over, and you get the compounding effect of the business. And had you done that here, you would have won. So $4.8 billion, it falls, kind of languishes in this 4.8 billion for a while, but then starts to pick up steam, peaking at $8 billion. Again, more than 50% of this is recurring revenue, and that is phenomenal. If I were to do a CAGR on that, it's about 7% annualized growth rate for their revenue. Definitely checks our box for top line revenue growth. EBITDA, enterprise level earnings. We do not mess around on this channel with EPS, earnings per share. I don't care. I'm a CFO in my personal life. This vlog for me is just for fun. And as a CFO, you can control the earnings per share by controlling the number of shares outstanding. So it has nothing to do necessarily with the underlying performance of the business. There's a lot of business. Take a look at McDonald's, for example. They use debt to buy back their shares to prop up EPS because they can't grow their EBITDA. Check it out. It's real. It's a problem for them. They have growing debt and flat earnings. It's a real fat EBITDA for McDonald's. It's a problem. EBITDA for these guys, $1.5 billion, grew to $2.9, almost $3 billion last year. Great job. That's a doubling in 9 years. Outstanding. That's an 8% annual CAGR over the time. Here's kind of the distribution. Not smooth, right? You're going to have up years. You're going to have down years. The point is, are you in a sector that's growing? Are you with a management team that can perform? And do they have a good product? I think those are yeses, and this thing continues to perform as it has done. So good job growing revenue. That checks the box. Let's look at the enterprise value and a couple metrics. So again, enterprise value, right? That's the entire business. You want to look at debt plus market cap. That's the value of the company. Here, long-term debt, short-term debt, it's come down. That's fantastic. EBITDA has doubled, and debt is actually down. That's $1 billion less debt. So that's amazing. Here's a company that is growing fast without levering up. That is a rarity in these markets, let me tell you. Excess cash, what is excess cash? That's one of the biggest single questions I get on this channel. Excess cash is merely cash that they should have distributed or they should have used to buy back stock that they did not. It's not an arbitrary number, but it is a number that has a lot of movement to it. Basically, any business needs a certain amount of cash on the balance sheet to pay bills as the timing of payments come in. For example, payroll is done every 2 weeks, right? You've got checks coming in every day. You're paying people every day. Payroll is a big chunk. It comes out every 2 weeks. It's not smooth is the point. So you need some cash reserve. Anything above that is excess, and it shows up here, and you exclude it from your net, your enterprise value. Market cap, shares outstanding times price. What I do is I add debt, market cap, less the shares, I get enterprise value. Excuse me, less excess cash, I get enterprise value. Enterprise value $11 billion to $75 billion, a monster run up, and you can see why. Why has that happened? Well, earnings doubled, right? Earnings doubled, but the market multiple of those earnings absolutely exploded, 7 times to 25 times earnings. So this is a case where a company's growing and the market is responding by paying a higher multiple on every dollar that they earn. So had you bought this back in the day, you would have not only grown in the business, but the market would have paid you more for every dollar that they generated, to the tune of 25 times more. That's huge, absolutely huge. On average, it's 18. I think this section is really, really low. This business to me is more of a 20x business because of the high recurring revenue that they have. 25 seems a little rich. It's come back a lot in this recent pricing decline, so I think it's becoming interesting. But let's take a look at the last column, debt to EBITDA. That has fallen in half, if not a little bit more, right? 3 times, which is our max that we want to see. But debt has come down. Earnings have doubled. That ratio has fallen to about 1 times debt to EBITDA, which is a great under-levered or low-risk company. And why do we care? Because debt is a risk of bankruptcy. If for some reason the economy were to tank, they would lose customers. The bank wants to be paid, absolutely has to be paid. And they are not going to wait around for the business to turn around for a year. They're going to liquidate. They're going to give you harsher terms. They're going to do all kinds of things to get their money back. Equity investors can wait. We don't like to, but we can. That's why you want to be protected by buying companies with less debt on them. Overall, this is checking the box, though. We've got revenue growth, yes. EBITDA growth, yes. And we've got low debt. Let's take a look at free cash flow. Okay, free cash flow starts with cash flow from operations, CFO. That was the first third of the cash flow statement that I referenced earlier. $1.3 billion to $2.25 billion. Annual growth rate is 7%, actual a CAGR. That is the same as the EBITDA, which means that the accounting department at Activision is appropriately expensing the cash costs that come in. You want to see those in line with each other. They don't have to grow at the same rate, but you don't want one going up and one going down for a long period of time. That's a red flag that they're just not expensing things properly. This seems to check that box. Next, CapEx. What we like to look at this channel is the spread between how much cash I'm generating from running the business day to day and how much I'm kind of obligated to put back in the business to grow and to maintain that infrastructure. And the infrastructure is very, very low, right? It's a software company. You would expect that. That means most of this cash can pass through the debt, which they don't have much, which means it passes through to the equity holders, who are us. It comes to us. That's what we want. You want a company that's generating a lot of cash flow, because that cash flow provided to the management team, who are experts in this particular field industry, should be able to invest that money wisely at a high rate of return and compound the growth. And they did that. That's evidenced by strong single-digit top-line revenue growth and strong single-digit bottom-line EBITDA growth. It's evidence of them being able to reinvest the money wisely and grow the business. So I like to see that. Share count. Share count has fallen from 1.1 million shares to 775 million shares. I think I said 1.1 billion here, to 775 million. That's an annual decline rate of 4%. That is fantastic. That means the ownership of this company, had you bought the stock back then, your ownership would have grown 4% on average, and you had to do nothing. You didn't pay taxes for that increased ownership. You didn't pay any capital gains for that increased ownership. That is phenomenal growth. And this company is an example of what I like to call a trifecta. It's a company where they're growing their earnings, EBITDA, so whole EBITDA is growing. There is a market multiple expansion opportunity. So every earnings that you generate, the market is rewarding you with higher multiples. That's going from 7 to 25. That's the second of the trifecta. And the third is share buyback. Your ownership interest in this growing company is also growing. Those three things produce a hockey stick growth curve. If you want to see how that works, check out my video, Domino's versus Google. I did it a while ago, but basically I looked at the IPO of Domino's and Google, which happened the same year, 15 years ago. Domino's outperformed Google since that time because you could have bought Domino's so cheaply. Domino's continued to buy back shares. They continued to grow, and they got a market multiple expansion over that period of time, which catapulted returns. Google did phenomenally well, don't get me wrong, but they were expensive at the IPO and they continue to be expensive. So it's an example of a simple, easy stock that can produce phenomenal returns. Anyways, that's the trifecta. This is a candidate, at least back then. Is it a candidate now? We'll see. Free cash flow per share, price, and then yield to round out. Okay, now let's forecast this business, something conservative. We'll figure out what we believe the stock is worth. Then we'll look in the stock market and we'll see what can we buy the shares for. But we form the opinion on what we're willing to pay for the shares today, now on our own through this model. Then we look in the market and we see what we can buy them for. Don't let the market taint your opinion of what the value of a company is. It happens all the time. All right, so EBITDA, the first thing we're going to grow, we're going to pick up last year's EBITDA, and I'm going to grow it at 6% for the 10-year period of time. 6%, a little less than the 8% they've experienced historically, to build in a little conservativeness. Also, because the growth rate is super lumpy, I don't know if this last year is a spike or it's going to continue, but I think 6% for this business is very, very doable. I'm going to give it a 20 times market multiple. That's a little higher than long-term average. But with more than 50% revenue recurring, it does deserve a higher market multiple. That means it's a $100 billion enterprise value in 10 years with about $5 billion, give or take, of EBITDA. Less some debt, I'm just using multiples of EBITDA to enterprise value to get that. And I get a $100 billion market cap divided by the today outstanding shares, and I get a $127 future price target using the EBITDA market multiple method. Free cash flow per share. Now what I'm going to do is I'm going to pick up free cash flow by using CFO, cash flow from operations, less CapEx. You can pick up the debt that they issued. If I go back to that and I take a look at this issuance here, they can support this debt. So if I include this in the cash flow distribution, that number is around $4 a share. This time I'm going to exclude it. I'm going to leave it out so it's just around $3 a share to be extra conservative. But because debt is so low for them, they could continue to issue debt as they grow and distribute that out. But I'll be cautious. I'll say it's $3 a share, taking last year's cash flow from operations minus CapEx, growing it at 6%, divide by the number of shares, I get this. Grow it for 6% for the year, and I get about basically $5 a share. I apply a 4% yield to that as a free cash flow yield, and I get a $125 long-term price target for Activision. Now that we have a price target for the stock, let's look and see what we can buy the stock for in the stock market. I can buy as much as I want right now for $66 a share, and I think it's worth, out 10 years or sometime in the future, $126. That's a doubling of the stock price alone, let alone the free cash flow it's going to generate and what they choose to do with it. Let's see what this looks like in an IRR. So when we use the IRR calculation, it's looking at this stream of cash flow here that this business that you're buying into as an owner of this company, you have a rightful claim to this free cash flow. What management chooses to do with it is their job. They could dividend it out. They could buy back shares, which they're doing, or they could go use it to acquire a company. Either way, it's going to be represented in the future price. Could be higher if they did any of those, but I'm assuming they dividend all of it out. And what it gets me is a net cash flow. When I IRR that, I get a 13% annualized return on the money that you buy the stock at $66 per share right now. That's about 2.5 times your money over that decade period of time. I'm assuming a market multiple stays the same at 20. If they go back to 25, that's upside here. I've got a 6% long-term growth forecast. If they hit the 8% like they've been doing, that's upside again. There's low debt. I think there's a lot to like here. Let's recap our 5 key attributes for this stock. Number 1, top-line revenue growth. Yes, absolutely, it's growing. Number 2, EBITDA. Absolutely, that's growing. Strong free cash flow. Yes, cash flow is strong and growing. Number 4, low debt. Yeah, it's less than 3 times. And well priced. Absolutely, the stock is geared to beat the market at 13%. that is a well-priced stock. If I put it into a distribution curve, just if the price moves around, you want to take a look at it. Here at $66 a share currently, it's yielding 13% in terms of a compound return over the time, assuming this math pans out, right? These are numbers behind me. They have to execute on this. But if that happens, you'd make 13% every year on your money for 10 years, which is great. As the stock price rises, return falls. If more bad news should come out and the stock falls even more, it becomes a greater buy in my opinion. All right, take a look at the website cashflowinvestingpro.com, where I teach a course where I provide this Excel template to you. I teach you how to run these models. I teach you how to read 10Ks. I teach you how to think about how to build a focused portfolio to hopefully beat the market and get where you want to go. There's a lot of companies out there that generate strong cash flow, that grow, and you can put your money with that should be safe, and they should continue to perform. And that's how I like to look at investing, as a passive strategy where you put your money with top-tier management with some guardrails around them, and you let them do their thing and go on and live your life. You look back 10 years and you're kind of making money, getting rich very slowly. And it's a more predictable way, in my opinion, of doing it than gambling on day trading. So if you're interested, check out my course. You'll also see the Cash Flow Investing Club there, where I give you the one-pagers on a whole host of stocks that I don't have time to do videos on. So we're going to give Activision Blizzard a good. I think it's a good investment at this point. Definitely take a look at it. And let me know what else you want to see. I've got comments down below, some amazing value hunters looking for stocks, commenting down below. Check it out. Thank you very much. Don't forget to hit the subscribe button and give me a comment down below. Thank you very much. Have a good day. Bye-bye.